Welcome to the show, everyone. Today we have a very special guest, and that's Jason Donville. Jason was in my book that was published in 2016, Market Masters, and by far he was among one of the fan favorites, one of the reader favorites of that book. I still receive emails on Jason and his investing strategy. Welcome, Jason. Welcome to the show.
Thank you.
It's been a while since we caught up, so I'm definitely excited about this one. Your fund has had a phenomenal year this year. It's up, I think it's up close to 110%. Since inception, you started the hedge fund, Donville Kent Asset Management, in 2008. It's annualized 13.5% compound returns since then. So again, phenomenal. There's a question that I think is on a lot of people's minds, Jason, but I don't think it's been answered out there, is who's the Kent in Donville Kent Asset Management?
Yeah, so the Kent was Harold Kent. He was my first partner. And when I started the hedge fund, I had all the courses and all the requirements, except I'd never worked for a hedge fund. So I had to actually get somebody who held the hedge fund license. So Harold joined us, and so we put the name together. And he was there for the first 2 years, and then when I got licensed, he decided to leave to start his own company. And the name just kind of stuck. So it was just like Merrill Lynch doesn't change its name every time Merrill or Lynch move on. So we just left the name, and it kind of had that name. It sounded like it was, a very established name, Donville Kent. It just sounded very proper and that kind of stuff. So anyway, so Harold went off and he started his own fund. And we haven't kept in touch recently or whatever, but he seemed, last time I talked to him, he seemed to be doing fine.
Yeah. And then since we talked close to 10 years ago, you've since taken a very big interest in the movie industry. You are actually a movie producer today. I don't think a lot of people know about this. So tell me what sparked the interest.
Yeah, it really started around COVID, where I had a lot of time on my hands, right? Because if you live downtown Toronto back during COVID, it was a ghost town. Nobody was coming to the office, and I started actually not in films. I started to write a novel, which I finished. I'm trying to get it published right now, right? And then that got me into more and more creative stuff, and I met a few creative people, and they invited me to a few events, and then before you know it, people who had little projects where they needed a few bucks, small dollars, like $10,000, $15,000, and I hope that doesn't sound arrogant to say that that's small money, but anyway, and I said, yeah, okay, I'm happy to help out, but my only condition is I want to be on set for the entire shooting of whatever you're doing, right? And these are like kids out of film school kind of stuff. This isn't Hollywood stuff, right? And then it just kind of grew from there.
That's really interesting. And you actually early on in your career, you've always been a writer. I think in my book you mentioned that, and you've been releasing the ROE Reporter since 2008. Tell me about writing for you and what it means.
Yeah, for me, it's a powerful form of self-expression, and everybody I think knows me as a finance guy, but I come from an artistic family, and I'm an artistic person myself. So I paint and I draw and I play guitar, I sing. So I outside of what you see in the finance world, I have this artistic side of me. But then when you get to a certain point in your life where you say, okay, the business is going great, but my kids are launched, empty nester. You've got the time to pursue other things. So then I started pursuing the things that that I was interested in. But I looked at all the artistic endeavors that I could potentially get involved with, and because I've been a business writer my whole life, it was easier to pivot into something like writing a novel or short stories, because I didn't have to teach myself how to write. I just had to teach myself the conventions of writing in that particular genre or format. And there is a format, when you write a novel a lot differently than you write a report about Ready Shred or Vital Hub, right?
Yeah.
But in the root of it, whether you're talking about a newsletter or even when I was an investment analyst or whatever, it's storytelling. Storytelling is at the root of it. And you'll look at CEOs like Steve Jobs or somebody like that, and they've done, I know he's not with us anymore, but many of these great leaders will tell you as they're motivating their teams, their people, they do so through stories, and they bring their teams into those stories. So there was, for years, when Apple was, believe it or not, was struggling. You got to be kind of my age to know that. People didn't leave because they just believed in their mission, that they were going to ultimately change the world and make it a better place, right? And they did.
The novel you just finished writing, what's the novel on?
It's about two Canadian peacekeepers who ultimately find themselves in Sarajevo in 1992 during the Bosnian conflict or whatever, when Canada was sent in troops to open the airport because Sarajevo had kind of been surrounded on all sides, kind of like Stalingrad. And so the airport was the primary means of bringing in food and medicine and all that stuff. And it's about the life of these two soldiers who had been friends in the army for 10 or 12 years, but both have traumas in their background, and those traumas essentially revisit them when they're in a war zone, which is quite normal. And then the rest of the story is how they kind of work through those traumas and try to find a better place in life.
And you also served in the Army, I should say Navy. Tell us about that.
So it's not a strict autobiography. I've been to Sarajevo and to Croatia, to the actual places where all this stuff happened, but not when I wasn't serving them. I was a naval officer. So a lot of the stuff about the military and that kind of stuff, the jargon, I'm familiar with that. But I was a sailor. I was a submariner and a diver. I wasn't an infantry officer, and the two characters are infantry officers. So there's aspects of autobiography in there, as there are with most writers when they write their first couple of novels. You draw on what you know, but it's not in a strict sense. I would say it's historical fiction, and a lot of it. I mean, what's also interesting about the two characters, and this is another part of my background, is the two characters when they first meet in Victoria, like in 1981, they have nothing in common except for one thing. They love lacrosse, and one of the characters is from Ohsweken, which is where Six Nations Indian Reserve is, and the other guy's from Calgary. So that, so one is a First Nations person, the other one is kind of a white Anglo-Saxon person. So a lot of what is a sort of part of the backstory is the conflict and attempt at reconciliation between an Indigenous and a non-Indigenous person growing up in Canada. So there's a lot of that kind of stuff in there, but there's also a lot of war stories in there. So this isn't a case of somebody like a non-First Nations person writing a First Nations story. The First Nations character is a really important character in the story, but really it's a story about, on some levels, about trauma, about how soldiers, when they go into war zones, are revisited by previous traumas in their lifetime, and then the things that they can possibly do to try to get to a place where they can be happy again.
Speaking of lacrosse, I see some lacrosse helmets actually behind you, I believe, right? Are you still playing? Are you in a coaching capacity?
No, I'm now mainly just a dad. But up until recently, up until maybe a year ago, I was the head of the national team program for Canada, so the men's and women's team. But that was primarily on a governance level, not on I wasn't picking players or coaching or anything like that. One of my sons is a professional lacrosse player, so every Friday or Saturday night I'm probably either in an arena watching him if he's playing nearby, or watching him on my laptop, kind of thing.
That's just great. Take us back to your early days as an investment analyst, Jason, and there was that little known company way back in the day called Stantec, and what was the discovery process there very early on?
Well, so I'd worked in Asia for about 10 years before I came home, right? And I worked for a place, a research house that was great at, stock picking and picking winners. And when I first came back to Canada, I went back to Calgary initially because that's my hometown. Then I moved on to Toronto about a year and a half later. But I'm looking around for great companies in my own backyard, and I found this teeny wee little company, about $85 million market cap, called Stantec, based in Edmonton, right? And so that was the first report that I ever wrote. And I think when you did the interview, I may have showed you, I still have it, because I was working for Acumen Capital Partners, who are still going. So I wrote this report on this company called Stantec. And it is cool to think that I wrote that report in, what year would I have written that report in? Probably 1999, 2000. And if you pull up a share price from 1999, and if I just put $100 into that stock and held it all that time, right, I could kind of retire. So there are these, your show to some extent is about compounders. There are these great compounding stocks that just go on and on and on and on. And if you're lucky enough to find them and not keep trimming them, because that's one thing is with the compounders, you gotta let your winners run. So that's what
people love about you, right? It's that you can discover these companies early, but you're willing to take a risk and bet on companies early too. Another example is Constellation Software.
Yeah.
I had a podcast recently, Jason. It's up on YouTube now with Jerome Haas of Lightwater Partners.
Yeah.
He said he bumped into you years ago at a conference, and this was when Constellation Software was at $70 per share.
Right.
And Jerome was talking with you, and he was saying, "Hey, I'm going to place a short on Constellation Software," and you said, "Don't do it." You warned Jerome, don't don't short Constellation Software. It's got the longest runway probably ever. But at that time, that may have sounded ludicrous, right? You're betting on a company that, in hindsight, is one of Canada's best run, maybe the world's best run companies.
Yeah.
Today, it's gone from $70, and today it's what, $4,700 per share.
Yeah.
So what led you to that, to the discovery of Constellation and just having the conviction when people didn't?
I don't think with any of those like multi-baggers, right? And another one that a new multi-bagger is in the news today, which is Vital Health. We can talk about that later, right? But I don't think you realize on day one how good those companies are. You get into them and say that it's good enough to own right now. So for the next 12 to 24 months, everything looks good, and then another 6 months goes by, and you sort your stocks from top to bottom, and you realize it's still in your top 5 or 10 in terms of attractive qualities that you're looking for. And then 5 years later, 10 years later, you're still saying it still keeps floating to the top. And I tell people, even today, after the huge run in the stock, if you could only have one stock in the Canadian market, it'd be Constellation, because of the combination of, on one side, the positive, which is the growth and the margins, but on the flip side is the balance sheet strength and the diversification of the business model within the company.
Talking about balance sheet strength, I think it still has the same 21 million shares. There's been no share dilution.
No new shares.
Yeah.
They generate cash flow so fast that they're often unlevered, right? They're more than capable of taking on debt, but they just can't find things to buy fast enough. The margins are typically over 20%. And it's just, also as a company that is predominantly operating outside of Canada for the last couple of years, the growth rate has been bumped by the translation of all their international earnings in currencies that are stronger than the Canadian dollar.
So 2006, I think May 2006, Constellation Software IPOs. At what point did you learn about it, Jason, and took an interest?
I found it right away, actually. Like, I found it with a month, because it didn't do a real IPO. It was a forced IPO because the big pension fund that had backed them, Amers or Teachers, required that they go public. Mark didn't want to go public, right? And so it went public with no fanfare, no raise, and no liquidity. And so that was a stock where, honest to God, to buy $10,000 of stock, it might take you 3 weeks. There was virtually no float out there, right? And then the numbers looked phenomenal, because the stock was trading on like 5 times earnings, right? And it had 25% growth, strong balance sheet. And I remember pointing it out to a couple of my friends, and I won't mention them by name, and their reaction was, I can find companies like that all over the place. Because the market cap at that time when it went public was about $500 million. It had a $500 million market cap on day one, with no fanfare, no publicity, no investor relations stuff, just Mark's annual letter. And so I built a little position in the company, and then I called up Mark and asked if I could have a meeting, and he said, yeah, sure, I came over, right? Now he tried to get a meeting with him. It's easier to get a meeting with the Prime Minister or the President of the United States than it is with him. He's just he's got the whole Moses beard thing going, and so I don't know what that's all about. But he had there was so little interest from the capital markets that he wasn't like badgered with people coming by. And so I show up to the meeting, and I don't know if you've ever met him. He's about 6'4", and really used to be really into working out and rugby and stuff. And I walk in, he's got an Under Armour. It's in his office. He's got an Under Armour golf shirt on that looks like it's slightly damp, like he finished his workout a half an hour earlier. And he walks and says, "Okay, you got 30 minutes." He was a no nonsense guy, but he answered all my questions, and away I went. And I met him a few more times. I got his AGM, but now he's really removed himself from that kind of stuff. He does his annual, his annual stuff, but I don't even know if he shows up at his annual stuff anymore. So it's like, this is not a criticism, but just to show you, like, this was such an odd duck for the first couple of years. But I'd write about it in my newsletter, and people would start paying attention, and I'd say these are the best capital allocators that I've ever seen. And then I also was playing Masters Lacrosse at that time. So this is around 2010. I was in an over 50 tournament or something in Florida. I was talking to this guy, and we were having a beer after the game kind of stuff, right? All a bunch of sweaty over the hill weekend warriors kind of, and so they go, "What do you do?" He says, "Oh, I work software." I said, "Oh, which company?" He says, "You probably never heard of it before, but he said, "Oh yeah, he didn't realize it's from Canada. It's called Constellation Software." I go, "Constellation Software? I own a whole bunch of stock." And I met with Mark, and so he started telling me about his experience. He had sold his company to Constellation, and then Mark had asked him to stay on for a couple of years, in transition to run it. And then when that 2 years came up, and somehow he got stock in the deal, right? And when the 2 years was up, he said, Mark's paying me extremely well. I love working for this guy. And the stock that I think he got partially paid in stock or whatever, he said, it just keeps going up. Right? And I said to him, and then I told him what I thought of the company kind of stuff. So this was a guy who sold his company and could have moved on, but he didn't. But he told me a lot of the stuff about the split between R&D and philosophically of how they look at companies and how they clean them up and all that kind of stuff, right? And so I just thought, and the reason why he's buying cheap is he's not buying high growth companies. He's buying relatively high margin companies and then just taking those cash flows and buying more of these. He's just buying more cash cows. The growth rate from the company in any given year, the true growth rate is anywhere between flat and 5%. So he's not buying growth companies, but he's buying a lot of mature SaaS businesses cheaply that are throwing off a lot of cash flow. So
when you make a new stock pick, Jason, and when you're on BNN Market Call, especially, people perk up, people tune in. Is appearing on BNN Market Call the same thrill to you as it once was initially?
I don't mind it. I mean, the world has changed a lot. We talked about this before that a lot less people are watching TV, so you know that the impact is not quite the same. But I mean, any form. You know me. Like I can talk like the kind of conversation we're having right now. I can talk about this stuff all the time, right? And I also enjoy hearing your opinions on stocks because a few times we've met and you take me through your top 10 or your core personal holdings that you've had over multi years, and I'm always interested, why and that kind of thing, right? So yeah, I'm always happy to talk about this stuff. And when I go on BNN in particular, I often try to do it. Look at where I'm saying, listen, I know how to manage my own money. I know how to manage the fund, but there's a lot of people out there who own individual stocks and they want to own individual stocks. So I try to say, okay, here's some really good stocks that I think are, they're not flyers. These are stocks that you can buy and hold, and on a risk reward, the risk reward trade-offs are attractive, right? If I'm recommending something super speculative, I'll hopefully point that out. Right? I say don't back up the truck on this one or whatever, right? But I would say Constellation Software should be a core holding, right? That's one of those ones. I think Vital Hub is in that category now, right? And so you're trying to sort of give back and be educational. And neither of my parents graduated from high school, right? But they're not dummies. They own a house or they owned a house, and they probably. Like my parents are like in their late 80s, and my mom's got Alzheimer's, so they're in wind down phase. But they're hardworking people who didn't have a great education, but they wanted to own investments beyond just their house. There's a lot of people who watch BNN are that way, and as long as you don't use too fancy jargon and just sort of simplify things without being condescending, but just make it really into a little story that they can understand. Everybody can participate in capital markets, and they should. People should, I often would talk to a person who's interested in the stock market and they don't know how to get started. And I said, well, you can buy an index, that's one. But tell me about the products and services that you admire. And I'd say to them, do you like using Amazon? Like, how often are you on Amazon Prime buying stuff? They said, then buy that stock. The fact that you're using Amazon all the time tells you that it's providing a service that's very valuable to you. And if that's the case, a lot of other people feel that way, and the stock will go up, right? And even for a lay person, just to build a portfolio around the products and services that they respect and that they like and that they consume, I think it's a great way to get started.
It's so true. I tell some people, just pull up your mobile phone, look at the apps on your phone, and start picking investments from there. Exactly what you said.
Yeah.
Amazon Prime, Facebook, et cetera, the list goes on.
It was the central premise of Peter Lynch's book, One Up on Wall Street, right? That the person out in the hinterland who's enjoying this really great cup of coffee in Seattle, and that chain is still just in the Northwest, and it's called Starbucks. And if that stock is available, then think that it's going to go a long way. Or equally on the other coast, if you love going to Dunkin' Donuts and it's still small in terms of its footprint, then buy shares in Dunkin' Donuts. Yeah. And every time you go to Dunkin' Donuts and you have a little sip of that coffee, right?
It's so true. It's amazing how easy investing can be, right? If you have the experience and you can narrow it down to that philosophy. It's so true. You are absolutely proven right, Jason. On short sellers in the market. Just this past summer, this is all public, Andrew Left was charged by the SEC for what they call a fraud scheme, bait and switch. And so what you said on TV was proven right.
Yeah, I don't regret saying that. I don't like the way a couple of journalists dealt with that stuff. because they were giving those guys really easy access to come in and just destroy and create runs on banks and all that kind of stuff, which I predicted would happen. But I now know that those guys they don't ever get on TV anymore. So somebody clearly read the Riot Act and said, wait a second, you're just facilitating these guys, right? So, but there's always new rounds of stuff that are out that you have to watch out for.
Yeah.
The high frequency trading, I think, is still an issue that's out there, where you just hit a stock really, really hard, and then everybody just gives up and walks away, right?
Interesting. Your strategy today at DKAM, is it still very much that high ROE pillar? Is that where you start, and these are the companies that you focus on, high return on equity?
Generally, yes, but I would make a couple of adjustments here.
Mm-hmm.
A lot of the companies that we like and that you like have a growth through acquisition component to them, right? So what ends up happening is the balance sheets kind of get distorted, right? So that when you look at the return on equity of Constellation or Descartes or companies like that, it's really hard to calculate the ROE without going back in time and making a ton of adjustments. So you can do it, but it would take you a couple of days if you were really good on accounting, and maybe a week if you weren't, to really figure out what the true return on equity is now. And so certainly in the tech world, we've moved to a new metric that's easier to calculate, and that's that rule of 40, which is when you're looking at a company and you look at a combination of the profit margin and the sales growth. And so that's more what we lean to now, just because we can't calculate the ROE on companies without doing a ton of work. Because when you're amortizing intangibles, right? You buy a company for $5 million and $4 million of it's intangibles, so you write off those intangibles, so there's only $1 million there. It makes the ROE look really, really high, but it's not really accurate in terms of what you paid, and yet, because even though there's all those intangibles, it doesn't mean that it's a worthless company that you overpaid. It just means so much of its value is built up in its brand and its knowledge and its service reputation and things like that, as opposed to something that's an actual hard asset, right? So that we use that rule of 40 as a good benchmark. So when I'm looking at companies, I say, okay, there's 1,000 companies I can look at today. I'm really screening off. I'm screening off of 4 factors to get myself down to maybe 10 companies to take a closer look at. And when I do that, I go, wow, I already own 7 of the 10. So what's the deal with the 3 that I don't own, right? Something new's come on there. So I'm basically looking for revenue growth, right? So if I'm looking at a new company, I'm not very interested in a company that's not growing by 12% minimum. I'm looking for a profit margin, and it can be below 40, but it's got to be, because even better than owning a rule of 40 company is to find a company that's at a 20, but it's going 20, 24, 28. It's improving. It's moving its way to 40, right? So I guess the factors I'm looking for: sales growth, margin, valuation. So those are the 3, and then the 4th one is a technical assessment of myself by just looking at the 1 and 5 year chart. And this is not like technical stuff the way like a guy like Mark Darriott does, where it's really complicated. It's just is it broadly speaking going from bottom left to top right? Because if I look back and say this company's been doing a lot of good stuff for a while and it's not showing up in the share price chart, then I can spend days to figure out why, and there is a why. You'll find out there's some reason why the accounting numbers look good, but the stock's not going anywhere, right? So that's the 4th factor. And so when I screen for those 4 things, I start with the technical, which is I'm only interested in looking at companies that are in uptrends, it's not a super just broadly speaking. I'm looking for a company that is going bottom left to top right, and there can be a little bit of chop and change in there kind of stuff. And over the last 5 years, the company ideally is kind of up, 85 to 90% minimum. So that it shows that on an average year they're compounding by 15% a year kind of thing, right? And all the rest of them I just ignore them if they don't have a positive chart. It's like, right, because that looking at the chart really does add what I call a momentum aspect to it. If the company is just moving up gradually from bottom left to, if you pull up a 5 or 10 year chart of Constellation, it's a work of art. But so is Descartes, right? Vital Hub was a tricky one because it just went flat for the longest time because it was super small, and then eventually it's taken off. And they just did a financing last night or whatever at around $11, and I wouldn't be shocked if in 2 years' time it's a $20 stock, right? But you and I, you own Vital Hub personally.
I do too. Yeah, I believe in it just as much as you do.
But your cost base and mine on Vital Hub is probably down in the 2.5 kind of
Yeah.
thing, right?
Yeah.
So probably 24 months from now, it's going to be for you or I, from where our cost base is, it's a 10 bagger.
Yeah.
So
it's just a phenomenal little company that
Yeah.
just keeps on getting bigger, as you say. You brought up an interesting point, and this happens a lot in the Canadian market, Jason, especially the last few years, when a price of a stock doesn't correlate to the underlying business fundamentals. Is it mostly because of illiquidity? Is it just that retail investors aren't supporting the stock early on? It's too small still for the institutions to start buying in?
yeah, sometimes it can be that. Sometimes it's also, an ambiguity in the story. Because I'll give you an example of a few stocks that are in that kind of area where people are trying to figure out. They've either had some oopses or whatever, and they're saying, okay, where do we go from here, right? So examples of that would be Cipher Pharmaceutical, Vertical Scope would be one, Sangoma would be another one. Those are stocks where I think they're going to continue to become compounders going forward, but they're going through some short-term thing because one of their acquisitions didn't quite work out, or something that they were hoping for didn't happen, and so the market's trying to resolve itself. So with those ones, I just say hold, but don't add to those positions until they start to move. You're better off getting into them once they start to go, because otherwise you're tying up too much capital in something that's standing still. And if by chance the market resolves the ambiguity in the stock and it actually goes down, then you actually own more stock in the stock you don't want to own, right? So there's a few like for example like Cipher, where had a great run, then a small part of their business, but a high profile one is a drug that they have for toe fungus. Doesn't seem to be going exactly the way they want it. But but the rest of the business, it really dominates its earnings picture. So the market's trying to figure out what the heck's going on, and then I think this thing will get going again. So in cases like that, and the market cap is small, but I don't think in this case it's a liquidity issue. I think it's a more of the market's trying to just make sure, well, what am I buying this for?
Yeah.
Right?
If we're to reflect on the Canadian small cap market, Jason, we're just about to close on 2024.
Yeah.
Has the rebound just started? Like, are we just getting going in small caps?
I think we got at least another good year for, if we go back this time last year, there was a ton of stocks, including some of the ones we already talked about, that were trading on 4, 5, 6 times earnings. There's still 5 or 6 that I'm tracking that are still at that point. And then there's another bunch that are at like 11, 12, 13, right? So I think the small cap side has legs. But there's other things that you have to look at into 2025 as well. So I think the small cap cycle kind of goes for 5 or 6 years, right? And I think we're entering year 2 of that 5 or 6 year run. But your biggest year definitely is that first year off the bottom, because in those troughing years, your multiples get so compressed that you just can't help but make money, kind of thing, right? But we obviously have a new president in the U.S. and we have Canada adjusting to that. We have a Liberal government that looks like it's going to get thrown out here pretty quickly, and it'll be replaced with something. Even if they throw Trudeau out and put Carney in, like Mark Carney's at least rational and understands the difference between redistribution and wealth creation and stuff like that, right? So I think either way we're going to get a better government for the business world. Trump's obviously pro-business, and a lot of people have issues with him on a personal level, and I would put myself in that category. But at the end of the day, I'm not an American. It's not my job to worry about that part. It's to say, is Trump going to be good for business? Yes. Are the tariffs going to be tough on Canada? Potentially, but a lot of stuff that I own are international businesses that happen to be headquartered in Toronto. So, if I own a big position in Constellation Software, there's no border issues here, right? These are businesses they own all over the world. If I own Descartes, it's not a play on Canada, it's an international play. And if I own something like GoEasy, which is a domestic play, it doesn't have any cross-border business. So, it would do badly if the Canadian economy does badly, right? So a lot of those things that could potentially be negative with Trump, I'm not tied into those as far as the investment portfolio goes. But I do think the U.S. market will rip, because you're going to get lower taxes and less regulation and all that stuff.
Let's say that in 2025, Liberals are ousted, fingers crossed, let's hope, and the Conservatives under Pierre Poilievre take leadership. Obviously, Pierre being a lot more pro oil and gas in Alberta. Would that signal to you, Jason, that perhaps it's time to add more exposure to oil and gas, junior oil and gas, or would you still not touch?
No, because not necessarily. First of all, if I am going to add exposure, it's through services, so that might not be a bad way, right? But I was even listening to something yesterday on CNBC, and it was one of the guys that was in the earlier Trump administration is coming back or whatever, and he was talking about drill as far as oil and gas goes, right? So you should get a surge in supply of drilling. That means that the price of oil and gas are likely to go down, not up, because you're increasing supply in relation to existing demand, right? So that means the service companies are going to be super busy, doing all this drill, but the commodity itself may go down, right? So I don't look at oil and gas as a slam dunk right now. I look at it as a pick your spots, and that's kind of what we've done. But we only have in the oil and gas area, we only have, I think Enterprise is the only major investment we have in that area.
Enterprise Group. Yep.
Yeah, and they do the generators that basically replace oil and gas generators with natural gas generators. So you could argue that the oil and gas, the diesel in the generators, existing generators, is more polluted than the ones that are natural gas. But environmentalists would say, no, we don't like either. So you can't really say it's a ESG kind of stock, but it's one where at least anybody who's using their stuff is bringing their carbon signature down.
Yeah.
But yeah.
And the philosophy still is it's very much a concentrated portfolio, right, Jason, at DKAM?
Yeah. No, we typically the top 10 positions are 75% of the portfolio. So we exist to make bets on great companies, and most years we get it right. You mentioned our long-term return, but we've gotten whacked twice in the last 20 years. And in both cases, it was multiple compression. Like the companies themselves didn't die. It's just a stock that was growing, a growth company that was trading on 14 times earnings was suddenly trading on 5, right? And when you get risk off and you have a lot of small cap in there, that's what happens. And I think that's one of the things that for people listening here have to be cognizant of is when you get a big move in the small to mid cap markets, well, even the large cap markets, right? And then you sort of go, okay, everything I own is great, but it's expensive, and you start looking for cheaper. You got to remember that you're sometimes in getting cheaper, you're also getting lower quality. Whereas a year ago, you could have bought high quality small caps cheap. A lot of the really great ones like Vital Hub are not cheap anymore. I think they're worth buying at today's price of $11. But when you look back and say it was only like 15 months ago that this $11 stock was at $2.75, right? And the earnings are up, but they're not up that much, right? So when you're sitting here looking at what you're going to do next, and you say, oh wait, I found some stuff that's on 4, 5, 6 times earnings. There's always something at that. It's like, okay, but are you really selling a high quality company that's a little on the expensive side for something that's quite junky and precarious, but it happens to be cheaper, right? So sometimes you can get a little bit seduced by the valuation arbitrage and not realize that you're not just going from expensive stocks to cheap stocks. You're also going from high quality to low quality. I don't think today is the day you have to worry too much about that, because there's still a lot of high quality stuff that I think is fairly reasonably priced. But if the market is up another 20 or 25% next year, I think that's something you have to think about when you get into 26 and 27.
CEOs are ultimately so important at the helm of these companies, but not all CEOs are the same, right, Jason? Some are exceptional at capital allocation, like Mark Leonard, and there's other qualities, obviously, in a very good CEO. What are those qualities? Like, tell me what you look for when you have meetings with them and you reflect.
Yeah, so even before the meeting, though, I don't disagree with anything you're saying, but the historical data on companies, some CEOs are great at saying the right things in the meeting, and then you look at the historical numbers and you go, right, like the company's not performing in line with this guy's. So he's managed all the buzzwords and all the investments speak, but you look at the actual track record and you go, it's not great. So for me, when you got when you have a good CEO, they have a credible plan to grow the business, right? So if the goal is to grow by 15%, then they know they need 15% more salesmen, they need 15% more this, that, the other, and it's just continuously being worked, and you can talk to them about it at any given time, right? That's kind of a leadership where they're always looking ahead to say what do we have happening on innovation, what do we have happening on growth, what do we have in terms of capacity, and you can have those conversations, that ability to look forward and to have a credible plan to provide for growth in the year or two ahead, and I would call that kind of growth leadership. And then every now and then we'll see a company go, geez, this company looks pretty good, it's got pretty good margins, but like there's something missing. And we'll end up talking with the CEO, and we'll realize the feeling is the CEO is actually an administrator and not a leader. They're dealing with stuff as it comes in, so they're administering the company, but they're not leading it. There's no vision of where the company can go, right? And what's really fun about the end of the market that I deal with is that you often get the CEO as a founder. So lots of that vision, lots of ambition, lots of growth, and a lot of calculated risk taking, right? And as soon as you get a professional manager into these businesses who's not a big owner or whatever, you get administration, right? You get, and I won't name names, but I can tell you 5 or 6 companies that should be doing way better than they are, and they're run by administrators, not by leaders.
Yeah.
Right?
So it's important for you to have a pulse in the company, because sometimes the leader can change personal reasons, and the direction of the company could also change as a result.
Well, if you go to a pharmaceutical company that has great margins but it's not growing, and you say, okay, so how many salespeople did you have last year? And they go, about 12. And they go, so how many have you got right now? And you go, about the same. You go, okay, so you're not growing the number of salesmen, so therefore, if you're going to grow by 15%, you're expecting each of those salesmen to sell 15% more, right? You only have to ask 2 or 3 questions. You kind of go, if you're not growing your sales force, then there's an assumption that each of your salesmen should be able to sell way more than what they're doing right now, right? And they generally don't. A new salesman will get to a point 6 months into the company where they're first learning the product and they're learning their client, and then they have a consistent monthly sales that they do, kind of stuff, right? So you can expose some of these people who are administrators as opposed to leaders, where you go, so what's your plan to hire new salespeople, right? Well, how are you expecting to grow? And oftentimes, another one that you'll see is you'll ask a CEO, like, so how much, just ballpark, what do you think you're going to grow next year, right? Even if it's on a conference call. Well, we don't actually provide sales targets or whatever. Busted. The good ones, all the good ones do, right?
Yeah.
Yep.
Yeah.
So
tell us, Jason, about
there's little things you can get out of meetings, but it's ultimately the thing that I'm looking for first is a credible understanding of how to grow the business. That would be the most important thing. There's other things, obviously, like your ability to work in teams and all that stuff. You can't really get that out of a 1-hour meeting in a boardroom, right? You can you can look at a team where you say, geez, there's a lot of turnover in the C-suite, so probably the person running it is probably a bit of a dick to work for, right? But as far as like figuring out who's a good team player and carries himself well and takes care of his people, there's a lot of people who've learned how to fake it. Just the same way people. There's some people who are brilliant at doing job interviews, but then you hire them and they're duds. There's a ton of CEOs that have kind of faked that talk or whatever, and then you look at the numbers and go, he doesn't have a clue what he's doing.
Walk us through your thought process before you put a short on a company. What's the process there?
So we don't. So we when, in the early days, we would actually go out and do a lot of work on a short, right? Mm-hmm. And now we don't do that. What we do is we just look in databases. We have 6 or 7 factors that we're looking for, and we buy a teeny weeny bit of all 50, and so we're buying what we call a bucket of right? And then we just short the bucket, right? Okay. As opposed to picking, in the case of longs, we're trying to pick winners. We don't try to pick losers, and the reason is it doesn't pay off. Right? It doesn't. You put a lot of work into stuff, and then all of a sudden it gets acquired the next day, even though the results are terrible. And so. And the other thing is with those people who are doing a lot of work on the losers and then going out and publicizing it, there's a kind of a sleazy element to that, right? And we talked about that earlier with the short sellers and the ones that go on TV and all that kind of stuff, right? So, so we just look at it and say, okay, let's look at the most overvalued, overlevered, Sales growth is diminishing. They are missing their results. Like that basket and any database, whether it's Seeking Alpha or Bloomberg or whatever, we'll say here's 100 companies that meet those criteria, and then we just we short that whole bundle.
Yep. Trading strategies. What other trading strategies do you deploy throughout the year to generate some extra alpha for the fund?
We don't. We're more buy and hold.
Okay.
But we tend to add to stocks when they're rising, and we don't tend to do a lot of averaging down.
Okay.
And the reason is because when the stock comes down, even if you like it in the long term, it very rarely V cuts back up, right? It usually comes down and then it goes through a long period where it's in the penalty box and there's all this broken stock above it. And so what you do is let it find its bottom, let it go sideways for a while, and when it starts to rise again, then add to the position. But yeah, we don't do those little cute trades where the desk is free to trade around a position and make a couple $100 here and help. I think it's that kind of trading is a myth that you can consistently make money, with the exception if you were on a big desk and you had feel for flow. Oh, I can see what everybody wants to buy. I can see what everybody wants to sell. But you have to be on a big trading desk to do that. I don't think hedge funds are a good vehicle for that if you have no feel for flow.
Yep. In your latest newsletter that you issue every month, I encourage everyone to sign up. Go to the DKAM website, sign up, follow what Jason's up to. You mentioned that since the dot-com boom and bust, you haven't seen such a delta in the valuations between large caps and small caps since then. It's been about 20 plus years. Why is there such a delta in valuations and that leads small caps to look so undervalued?
So there's theories on this, right? And I would say here's one of them. The index phenomena, right? Where you buy the NASDAQ index or you buy a basket of large caps or whatever, right? That's where a lot of that trading takes place, right? And so the liquidity goes there, and then the weight of money goes there. So everybody wants to own the Mag 7, that kind of stuff, right? I can't prove that. There's probably somebody out there who's written academic papers that says, yeah, that's a big part of it. So that's one theory. The second thing is when you look at the Russell, like the Russell 2000, the small cap indexes, right? And you look at, they take like the Russell 2000 and said, imagine the Russell 2000 is one company. Let's take the aggregate revenues, the aggregate profits or whatever, right? And then they compare that, let's say, to the Mag 7 and say the same thing. The Mag 7, let's combine the Mag 7 as 7 companies into one big mega company, take all the Russell and make it another mega company. The growth rate of that Mag 7, right, the return on equity, blah, blah, is phenomenal compared to it. That Russell 2000 is barely growing because amongst all those gold and little things that you and I are talking about where we go panning for gold and find these vital hubs, there's a ton of garbage in there that is losing money and it's not going anywhere, right? So the small cap phenomena that people talk about from an academic point of view and that small caps outperform large caps, blah, 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 it's not as clean as what people are saying. If you have the ability to analyze companies and go into that small cap world, right? Because I know a lot of the stuff that you and I own that we've owned for a long time. When we first started getting involved with them, they were $1 billion, $500 million. They weren't micro caps, but they certainly weren't even mid caps, right? So we were able to go down and find these things. And then as they get larger, they come onto a bigger audience and they get a re-rating and all that kind of stuff. So I think part of the reason why their valuation differential is such that it is that the economic characteristics of that basket aren't that attractive right now. If I for some reason was retired, or for some reason I didn't have the ability to buy individual stocks, I wouldn't buy the Russell 2000 because that basket in itself is not growing very fast. It's got tons of dogs in there. The return on equity is really, really low. I'd own the NASDAQ. And there's a number of different ways to slice the NASDAQ, where you do it on a market cap weighted basis or not. But that's where I would put my money in the NASDAQ.
Speaking of the U.S., there was a time when you were hunting in the U.S. and you're adding companies into the fund. American companies. Are you still hunting in the U.S.?
We are, but we don't have that much in the States, in part because the valuation differentials between Canada and the United States are just unbelievable, right? It's, I was just screening through a bunch of the U.S. stocks this morning ahead of your call, just to refamiliarize us with some names. And if you're talking about, I track about 200 U.S. companies quite closely. And as far as looking at 2025, how many stocks are trading below 20 times? Maybe 8 or 9 out of 200, right? It's and then you go, okay, what if you want the that rule of 40 quality companies with maybe one exception, and it's a super levered company, so that's why they're all at 30 times plus, and a lot of them are at 40 and 50 times, right?
Mm-hmm.
And so you look at what we're looking at on this end here, right? And I know that there's question marks over some of these companies that I'm going to name here, but on my numbers looking into 2025, I have Cipher Pharmaceutical on 5.4 times cash earnings. I've got Vertical Scope on 6.6 times cash earnings. I've got GoEasy on 7.4, Enterprise on 7.6. I've got Propel on 10.8. I have MDA Space on 14 times next year's earnings, and it's growing at 30%. Right? Like these are good values, and even a company like Zedcor that's absolutely ripped, I've got on 16.6 times next year's earnings, but I think my numbers might be light. So even Constellation, I've got it on 20 times 2025 earnings. If that's a U.S. stock, it's on 45 times earnings or 50 times earnings. Right? So the valuation differential just doesn't allow us to get too excited about the States because Canada is just so cheap.
Yep. There was also a time where I don't think you pulled the trigger, but you were touring and thinking about maybe adding some Asia exposure as well to the fund. Where's your thinking there in Asia now?
Yeah, I looked sort of outside North America, whether it was Asia or what have you, right? And I just didn't want to go like that, spread myself that thin. It was an idea that crossed my mind. I was on a trip there anyway, so I was sort of thinking about it. I did though I've talked to a couple of U.S. fund managers who do global small to mid caps, and they follow our newsletter quite closely. And every now and then they'll call up, and they were sort of saying, "Wow, Canada's a great place for high ROE stocks. Like not a ton of them, but your 15 or 20 best companies, like we've talked about before, right? The Constellations and the Descartes and others. They go, Canada clearly has those. He says there's companies in Europe that don't have a single company that would have a high ROE and a multiple kind of stuff. But he said Scandinavia actually has a lot, Canada has a lot, Australia has a lot, and there might be one or two places in Asia kind of stuff, right? And the guy was saying, even though we're a global fund, we're getting most of the gold in our portfolio is coming from about 7 or 8 countries, and there's a huge number of countries where there is nothing. Right, like just nothing. Like I don't know. Sometimes when, I'm sensing from your earlier comments about Trudeau that you're politically more to the right or whatever. But I don't think when people think about how wonderful things are in France and Germany, if they realize there's no wealth creation going on there, their social programs are suffocating their economy. You and I, we live in Canada, but I've spent not a lot of time, but some time in Silicon Valley. You meet tons of people from Europe who've finished their degree in France or in Germany and then moved to California to start a company. And you go, because the circumstances of trying to be an entrepreneur in those countries is so onerous. And so, when progressives try to paint this idea that, oh my God, we're going to expand social programs to the point of suffocation so we can be just like Europe, it's like, you got to go to Europe and see how bad it is. Right? It's there's no growth, and young people are not graduating and getting good jobs. Right?
Yep.
If you don't, I've said this to a few of my friends for a while, and I tend to think of myself as more of a political centrist than a person who's on the right or the left. But I said, whatever party is going to run Canada for the next little while, the next 10 or 15 years, they have to come to peace with entrepreneurship. They have to recognize that entrepreneurship, it creates jobs, it creates a ton of tax revenue through income taxes and payroll taxes, blah, blah, blah. But if the entrepreneur is successful, he or she is going to get wealthy. Get over it. That's what you have to live with. And the idea that somebody's going to get wealthy drives them crazy, but they want all the other benefits. And they go, they're interlinked. You can't have it both ways. You can't say, start this company and create all this employment and pay really good wages to your people and pay all those payroll taxes and income taxes, but we don't want the guy or the woman who started the company and took all the risk to get wealthy. It's like, it doesn't work that way, right?
Yeah.
And they should be legitimized by that. We should say, yeah, that guy got rich, but we're okay with that because look what he did. or she did. Look what she did in terms of the employment she created and the tax revenue she created, kind of stuff, right? We should be looking at the entrepreneurs and saying that's earned, right? And all of the parties are going to have to come to terms with that, because even with Paul Revere, he hasn't played out his policies for the most part. He's mainly just been letting Trudeau, suffocate himself, so to speak, right? With one bad thing after another. Like it's just crazy. But also, he's not playing out his platform yet because he doesn't want it to come under attack until just before the election, where he'll say what that kind of stuff is. But what we don't know when we look at the Canadian Conservative Party, federal party, is how much of it is a populist party and how much of it is a conservative party, right? Because one of the things that the left likes to throw is like, oh, there's Paul Revere playing to his big business buddies, right? And I'm a Bay Street guy, right? And I know, at least as of fairly recently, everybody here in the corridors of power, they go to liberal fundraisers. They don't go to conservative fundraisers, right? I don't know anybody on Bay Street who goes to Rob or Doug Ford's, the Ford family's shindigs or whatever kind of stuff, right? Like, and when you look at the voting patterns of the wealthiest neighborhoods, like in Toronto, they're not voting conservative.
No,
they're
liberal.
voting liberals, and in some cases NDP, right? Yeah. So I don't know if we're going to get a kind of a Diefenbaker type of populist conservative government, or we're going to get a pro-business one. But that's why I say, even if Mark Carney gets in there, he's already said that they've spent way too much time on redistribution and not enough time on wealth creation, and that runs out of steam, and it's long since run out of steam here.
Yeah.
If you're just going to keep reslicing a pie that's flat or shrinking, people are just going to get ticked off.
Yeah. And you're saying this from a good place, right, Jason? Like, it's not like you got any help early on. You're not a trust fund kid or anything like that. Your parents were middle income, and yet we don't celebrate entrepreneurs like you who take risk. It seems like the tall poppy syndrome has gotten even more pronounced in the country, in Canada.
Yeah, well, I mean, and some of it's Canada and some of it's what's happening around the world, right? We live in a world of grievance culture, right? Where anybody who hasn't become something fantastic in their lives, the reason is because they've suffered some injustice, right? And it's like, and I don't come from a middle class family. My family was not well off, and we had a lot of substance abuse issues in my family, right? So I'm not saying that for anyone to pity me, but there's a reason why I went to the military when I left high school. It was because A, I needed to get away, and B, that was the trade-off. If you'll serve your country for 8 years, we'll give you a fabulous education. And for me, that was fantastic. So all you Canadian taxpayers that helped me get my education, thank you very much. And I can assure you that I paid you back in millions. So hopefully, I look at it, it was a good deal, damn good deal for me. Fantastic deal for me. But it was a good deal for Canada. You made a good citizen who went out and started businesses and has paid a ton of taxes to validate the fact that people place that trust in me. Anyway, if you buy into that mentality, because I have a lot of family members who are still kind of in that blue collar kind of world. Which is fine, because being a tradesman, I think, is a very respectable thing, right? To be an electrician or a plumber and that kind of stuff. But if you buy into a victim mentality, it undermines so much for the rest of your life. You know how we talk about trust fund babies who, because they know they're wealthy, they never amount to anything? The self-pity thing has exactly the same effect. You keep thinking that you didn't do well on your math exam because of injustice, and you go, no, you didn't study hard enough. Keep yourself in the pants and get a higher grade the next time, right?
Yep.
And there's a lot of that kind of feeling out there that I didn't get my share because of this injustice. And it's like, if you really believe that stuff, it will actually hold you back dramatically.
I agree. It'll hold you back. It's all up here. It's all mindset, right? It's grit. It's perseverance. Tell me what you're excited about, Jason, for 2025. What's your thoughts on the small cap market in Canada? Tell us about your best ideas, the companies that you're thrilled about for the new year.
There's a couple things that are like new flavors, new themes.
Yeah.
A lot of talk about AI. Is AI just a whole bunch of hype or whatever, or is it really fundamentally changing things? I think it's changing things dramatically, and both positively and negatively, right? But from an investment point of view, positively. The negative is, I think that with social media and click culture, it's creating a massive amount of negativity, and it's also, we're spending too much time on our phones and not enough time talking to people. We're not being social enough. But separate from that, yeah, I think this latest wave of as far as what started with the internet in kind of 94, 95 is absolutely amazing. It's making certain companies so powerful and so effective. And therefore things happen fast. So, how we, I don't know if you've ever seen these things about the S curve of technology adoption, right? Where some, where they say, from the time that they say the time that the first family in the United States got a TV to the time where where 99% of households got a TV, that time frame was, let's say, 27 years, right? Yep. And then cell phones, it's 9 years, and these cycles are just getting tighter and tighter. So the rapidity of technology is absolutely amazing. And if you happen to be on the right company, the profitability can be really, really explosive, right? So yeah, I think there's a lot of really, really great things that are happening in the business world. And purely on a business side, obviously Trump is going to be pro-business, and I got to think whoever is going to become the next prime minister has to turn pro-business, because we don't have any choice, right? We've been stagnating economically, and when you travel around the world like I do from time to time, and then you come back and you're driving around, Saskatoon or Edmonton, and you go, we're not that rich country anymore, right? And then you go to Zagreb in Croatia, and you go, this downtown Zagreb looks a lot nicer than downtown Edmonton, right? Like we don't realize how much. And then you go to places like like Singapore, and you're just like, oh my God, people think, oh, it's Asia. It's a lot of people still have these perceptions, and they go, the GDP per person in Singapore is 1.5 times that of Canada. When I first went there in the 80s, it was 1/5 of Canada. It's now 1.5 times higher. So they can afford nicer hospitals. You shouldn't go. You go there and go, oh my God, the hospitals in Singapore are way nicer than the hospitals in Canada, because they're way wealthier than us, and they're going to continue because they've got pro-growth policies in their country. So
we've come so far behind, right? If you were to think of any pure play Gen AI opportunities in the Canadian market, can you think of any companies investing in Gen AI to innovate and push the company forward?
So Propel is the closest pure AI company that I can see, and they're an online lender, and they have operations. The bulk of their operations are in U.S., Canada, and the U.K., right? And they have like 12 PhDs in their company that are like the guys that come out of Stanford, and they got PhDs. So that's the most sophisticated AI play that I can see that's out there right now. All the rest of them that have the word AI in Canada, the vast majority are promotes, right? All the guys who did the cannabis thing the last 5 or 6 years have all gone and find like little obscure companies with no revenues, no earnings. They put the name AI on them, and then they tout them, kind of stuff, right? So, and I might be wrong, but this is the pattern, right? And you'll see more of that going forward. But anybody who's doing software, right? So once again, you and I have spent a lot of time over the years talking about the software consolidator. So VitalHub, Constellation, it's 2 spinouts, Lumine and Descartes, companies like that. Those 5 or 6 companies, right? If you just today took those 5 or 6 companies and put, all your money equally spread over those 5 or 6 companies, and then put them in a drawer and came back 10 years from now, I think you're going to be up 300 or 400%. But AI is all embedded in every level of those companies, right? Because even like in a simple company, anybody who's generating sales leads off the internet is using AI. Even if they bought the tools from a software company, the stuff that they're putting into it, right? And there's a good chance if you're using it for sales generation, that the company who you sold the software to has got access to your data that's being fed back to them. So they're learning stuff from how you're playing with the markets and that kind of stuff. So everybody's in AI to one extent or another. But I would just say, in terms of pure plays, you got something like Propel that's a real pure play. Most of the successful software companies that are out there are doing it. You get the software tech, not software, the IT services companies like CGI. They've got AI components to it. So, we don't have that many what I call truly pure plays, but we have a ton of companies here that are doing a lot of stuff. Even Go Easy's growing faster than the banking system, right? Pretty sure that they're sourcing loans and demand out of the marketplace using tools that are AI enabled.
And you wrote about this in your latest newsletter again at Constellation Software's AGM. there's a question that came up on whether AI is a threat to Constellation Software or not. And what was the response?
Yeah, I can't. I mean, the like you got to get the official response, and then you kind of look at it and say, regardless of what their response is. So this is more what my response is. There's no large company within Constellation. Like it's almost like it almost doesn't matter what they say. Mm-hmm. You have to go almost company by company and say, is AI a threat to you or not, right? And for that, you have to look and say, okay, how fast is your industry growing? And if you're not growing as fast as the industry, is there a chance that somebody who's got an AI tool or whatever, right? So I think when you talk about the big picture stuff, and you're talking to somebody who's talking about Constellation as the machine, in a sense, it doesn't matter, right? It more matters at a granular level in terms of what an individual company is doing. My feeling with AI, because I'm doing stuff in the film area and I'm doing stuff in the mortgage area with another company, and then I've got the fund and that kind of stuff, and then I'm an avid reader of the Globe and Mail and the New York Times. I'm kind of seeing all this stuff meshing in, right? Like joking aside, we talked at the outset about my first novel, right? And hopefully I'll get it published this year. And the next one, I think I want it to be a dystopian novel about a hedge fund manager who's like seeing all this AI shit by day, but then going out into the real world every day and walking on the streets and seeing other stuff and how it's all kind of interlinking, right? Because I think about that all the time when I'm looking at a company or hearing something about a company that's doing AI, and then I'm thinking about something that happened in the drugstore this afternoon, right? So
it's so true. It could come sooner than we think, right? A future like that. So in that same newsletter, you list several companies in your basket of long-term buys. So you list, of course, Constellation Software. You're super early on that, talking about first adopters. Vital Hub, Vertical Scope, Cipher Pharmaceuticals, Go Easy, Neat, Propel Holdings, MDA, Enterprise Group, Zedcore. Are there any more recent, maybe smaller positions that you've taken on that you could add to in 2025?
That's pretty up to date.
Yeah.
Like we're like Jesse and I are going to do a portfolio review in the next couple of days, kind of thing, right? Just as we do periodically, but we really wanted to wait till the market had stopped trading. But one of the companies that we haven't talked about as far as a new name, so it's really new to me in the last 3 or 4 months, is MDA Space. And that's a company where it looks like they're going to grow at 25 to 30% for the next 3 years, almost just on the basis of the order backlog. They're sorry, I'm just going to have a little sip of cough medicine here.
Yeah, all good.
They're only trading on 14 times earnings. They have good margins, but there's always rumors where every time there's a major satellite deal going down that they're going to be a player in it.
Yep.
So I look at this and go, that trade-off between risk and reward looks really, really safe here. We have stuff that's cheaper, but MDA looks to me like just a really straightforward.
And Telesat is not in your radar, right? Telesat?
Nope.
Okay.
Look at the chart.
Yeah. Yeah.
Pardon me.
What's the best part about your job, Jason? Looking back since 2008, what gets you up in the morning? What motivates you to this very day?
I think there's a couple things, and so one of them is obviously just being able to talk to people like you, right? Yeah. There's probably people sitting out there, and that's why content creation is really fascinating in our space, where there's people going, oh my God, wouldn't it be cool to come in the morning and have a morning meeting where I could sit around a table and there'd be guys like Jason and Robin talking about this stuff.
Yeah.
We only talk for 20 minutes, but then I had the rest of the day to go off and read about stuff, and the next day we'd do this all over again, right? And when I used to work in the investment banking world, like at Cormark and stuff, you had a morning meeting, and the morning meeting was always the best part of the day, because for 30 minutes everybody would share their ideas. You get to hear other people. So that's one. The other one is I'm a highly curious person, and I think you are as well. And so I need that stimulation of new things, new ideas. I love to get my head around all kinds of stuff. So I think that ability to indulge curiosity is one. I'm sorry, somebody was waving at me through the window.
That's okay. No, we talked about Gen AI in the context of companies, investable companies. But have you or Jesse tinkered around with Gen AI and how it could help you maybe in your stock research?
No. No.
Yeah, it's just not there, right? It's just
And
too
it's
dumb, basically.
It's like, notwithstanding the fact that we've had a couple of tough years, but we've had a lot of good ones, right?
Yeah.
I'm comfortable. Fairly comfortable with the methodology that we use in terms of helping us find winners. And when we can't find winners, that's a pretty good indication that it's time to go to cash.
Yeah. Now there's some money managers who might say that it's impossible to construct a Canadian-only portfolio. What would you say to them?
No, not. It depends how if you said I have to have a 30 stock portfolio, because there's other stocks that don't meet our criteria that are still, I would say, are good long-term holds, right? We don't have First Service or Dollarama in the portfolio, but those are good companies. If I make, they don't make the cut of what I'm looking for. But if somebody walked up to the street and they said I have 12 stock portfolio and it's like Dollarama and First Service or Colliers or something like that, I would say, yeah, those are good companies, right? I'm looking for the best, but those stocks, those 2 or 3 stocks I just mentioned would still be in the top 50. And you think about what how you could diversify it. I also don't believe you have to own oil and gas. Sometimes you'll hear people on TV say, well, for my oil and gas weighting, if the sector sucks, then don't own it. If the TSX has an 11% weighting in energy and you have a 0, why is that a problem?
If we're to talk about information flow, I think people are super interested, the do-it-yourself investors, and where does Jason read, get his news flow? It could be anything out there. What tabs do you usually have open on your Chrome browser, Jason? Tell me what you're reading daily. How do you keep up to date?
It's primarily so I read the two newspapers, which is the Globe and Mail and the New York Times. But as far as the investment stuff, it's primarily research that's being produced by the research industry, and the investor relations materials like the decks and that kind of stuff. And then a lot of it's just conversations with people. And if I'm going to read something important, it's going to be a published book.
Yeah.
Right. There's not that much. There's not that much in terms of profound. Like, we used to have things like Fortune magazine and Red Herring and things like that, where you could get these really well thought out think pieces on an industry or technology. Right. There isn't that much around anymore. Like, I was in a Shoppers Drug Mart the other day, and I went to the newsstand. I was just waiting for a prescription to be filled. And I went to see if I could buy myself a copy of Fortune magazine. Well, I don't know if Fortune magazine is published anymore, but if it is, they didn't have it.
That's a good question.
Yeah, and we used to have 3 or 4 business magazines that were available in the newsstands, right? So if you felt like you wanted to binge on business magazines, you could get a bunch. Now you've got The Economist, which is excellent, but The Economist is really more of it's an incredibly well written magazine, but it's not really a Fortune magazine or a Business Week.
Yeah. Speaking of published books, your business and finance bookshelf is probably about 500 to 600 books.
Yep.
Large.
Yep.
It's in your office here, and then in your personal residence, you have another bookshelf, which is personal reading. What would be for viewers of the show? What would be the most interesting book that you have on your personal shelf? Do you think?
Oh, that's a tough one.
Yeah. Where people think, wow, I would have no idea that Jason would read a book like that.
I think. There's a writer, I'm trying to think of his name, but he wrote a whole bunch of books a few years ago and won a whole bunch of awards. And he wrote like a biography of Rockefeller, right? And then Rockefeller, he did one on the Warburgs, that kind of, and just incredibly well written and really good storyteller. And then the last book he wrote was turned into that musical. What's that musical everybody's talking about, that everybody's raving about?
Oh, geez.
You know which one I'm talking about, though, right? It's a musical that like everybody loves.
Yeah.
And it was by far his most boring book. And when my daughter told me that he turned that book into a musical, I was just like, that book is dry. It's all about the establishment of the Federal Reserve. It's dry, and it's got a lot of details or whatever. Hamilton,
yes.
So he wrote the book on Hamilton, right? And and it won. He wins things for historical, like business history kind of stuff. And my daughter's saying, yeah, Dad, they made a musical called Hamilton. It's based on his book, and it's fabulous. And I'm going, Hamilton's about the origins of the Federal Reserve. That's about as dry as it gets, even for a nerd like me, right? Anyway, so I've seen Hamilton. It's wonderful, right? But it's just like that would be. So I think for a lot of people, unless you're like really into like accounting and stuff like that, I think business. Every year there's a new business biography or two that are on the newsstand, right? Either the story of Steve Jobs or the story of Apple or the story of Musk, like the story behind these big companies. That's where I would go. Nothing I can think of that I can recommend right now. I mean, I'm reading right now a book on the history of the independent film industry, and it's really, really cool. I can't quite remember the title, but it's outstanding because once again, I'm doing a little stuff in film, so I'm reading about the industry, and it's all about the beginnings of the Sundance Film Festival and Miramax and Harvey Weinstein and his brother and all that stuff. So really rich characters, Robert Redford, that kind of stuff, and a lot of the backstories on these guys, and so.
And when does the latest film come out that's currently being edited? Is there a release date set?
Junkie Run, I have a rough cut, and I'm hoping that we'll be looking to go into film festivals by April.
Are you involved in the creative process as well, Jason? Like, do you lend ideas to
not yet,
casting?
Right? But that's part of the reason why I got involved with this stuff. Is at some point I'd like to do my own stuff.
Yeah.
But up until now I've been backing other people's ideas. So, but I have a few ideas. I mean, and I've also obviously got one novel that I'm trying to get published and a second novel that I'm starting to, mentally think out. So
You have a lot on the go. In terms of business ventures, do you have anything planned for the next, let's say, 5 to 10 years that you envision?
Not too much, but I love coming to work, and I still have a lot of energy. So I mean, Buffett did this till he's in his 80s. So unless I like lose it or something, I still love doing this, and some of them I think, well, you're doing all the film stuff. Well, the film stuff tends to be on the weekends and in the evenings, or I take a week off and I'm involved with it, right? So it's not really a distraction. But I'm a single guy who lives on his own. My kids, two of my kids don't live in Canada, and so I've got a lot of time on my hands. So I quite enjoy this stuff, and I've never really been a person who comes home at night and watches TV for three hours. I make dinner and then I get into a good book or something like that, right? So this creative stuff has been a nice add-on, but I still love coming in the morning and turning on the screens and all that stuff. So.
For the do-it-yourself investors, Jason, that are watching the show, what advice would you give them? What would set them up if they were to start with, let's say, $10,000 out of university?
Yeah.
How do you parlay that into something much bigger in 30 years?
I would say, I sort of gave you 3 or 4 criteria at the beginning to look for, right? You're looking for compounders. Understand what compounders are. If you're really going to do it yourself, then you got to figure out what your system is. And most of the great investors don't invest all over the map. There was a couple of books done years ago where they did this portfolio analysis of a lot of different portfolios, and they went out. The great investors have relatively tight portfolios around certain attributes. So
this has been great. This has been a lot of fun to catch up, Jason.
Yeah, really,
Jason, I appreciate the time. Yeah.
Okay. Well, I listened to all your stuff and look forward to seeing this and seeing how it comes out.
Yeah. Thanks, Jason. Have a great one.
All right. Take care, Robin.
Bye.